Oracle just had its worst week in 25 years, and it's not because of a failed product launch or a data breach. It's because Wall Street is panicking about where all the AI money is actually going. Here's the thing that nobody expected. A company worth hundreds of billions of dollars suddenly looked vulnerable, and when that happens, it signals something bigger is broken in how we are financing artificial intelligence. Oracle is the invisible backbone of most big companies. Banks, hospitals, airlines, government agencies all run on Oracle database software. They've been here since 1977, survived the dot-com crash better than almost anyone, and built an absolute fortress of a business where customers pay subscription fees forever, locked in by contracts worth hundreds of millions of dollars. But this week, Oracle's stock collapsed 17%, the worst week since 2001 crash, and that's not because they made a bad product. It's because investors are asking a question nobody wants answered. If the cloud companies and chip makers are hoovering up all the AI dollars, where does that leave everyone else? The irony is razor sharp. Oracle is actually trying to build AI services. They've invested billions. But none of it matters if the market decides the real winners of the AI era are somewhere else entirely. When a company that big loses faith that fast, everyone watching has to ask, is Oracle a warning sign? To understand why Oracle's crash matters, you need to know what they actually do and how different it is from the companies winning the AI race right now. Oracle has two core businesses. The first is database software, the systems that store and organize all the critical data for Fortune 500 companies. Banks use Oracle to manage trillions of dollars. Airlines use it to track hundreds of millions of passengers. Government agencies use it to keep the lights on. Once a company trusts Oracle with that, switching costs are astronomical. You'd have to rewrite entire systems, which takes years and hundreds of millions of dollars. So Oracle's customers are locked in forever, paying subscription fees whether they love the product or hate it. The second business is cloud infrastructure, basically renting out computing power to run software on Oracle's servers. Oracle Cloud is smaller than Amazon Web Services or Microsoft Azure, but it's been growing. For 40 years, this lock-in model made Oracle one of the most profitable companies on earth. But here's the critical bit. Oracle makes money on steady, predictable revenue. Customers pay the same fees year after year. Their growth is measured in single-digit percentages most quarters. Meanwhile, AI companies like NVIDIA and OpenAI are growing at triple-digit rates. The market has become obsessed with growth at any cost, and suddenly, Oracle's slow, predictable 5% annual growth looks boring. This week, investors fled Oracle in panic. The stock fell 17% in 5 trading days. That's about $140 billion in market value just evaporated. To put that in perspective, that's worth more than the entire market cap of Intel or most European countries' GDP. The speed was staggering. Why did it happen all at once? On Tuesday, NVIDIA reported earnings that crushed expectations. Their data center revenue is exploding. On the same day, Oracle reported their cloud revenue growth slowed, not collapsed, slowed. The quarter was still profitable. They still hit their targets, but the numbers came in slightly below what Wall Street had been praying for. That shouldn't have triggered a 17% crash. But here's what happened. It gave a name to the anxiety investors have been feeling. If the AI boom is concentrating all the value in chip makers and cloud giants, where's the money for everyone else? Oracle's earnings call didn't help. Management got grilled on stage about AI strategy. They outlined plans. They sounded confident, but investors weren't listening. The real shock wasn't the numbers, it was the message underneath. The market looked at Oracle and asked, in the AI era, are you essential infrastructure or are you legacy? And because Oracle couldn't convince them of the answer, $140 billion in shareholder value vanished in 5 days. That's the kind of move that signals something fundamental has shifted in how the market values companies. So what does this mean in the real world? Think about how companies are actually spending on AI right now. Amazon, Microsoft, and Google are pouring money into building AI infrastructure, data centers, GPUs, their own AI services. NVIDIA is making the chips that power it all. OpenAI, Anthropic, DeepSeek, these companies are getting billions in venture funding. Oracle built AI services too. But here's the problem. If you're a Fortune 500 company deciding between Microsoft Azure's AI tools integrated with your existing Microsoft software and Oracle's AI tools, the choice looks obvious. Same with Amazon Web Services. They already own your data. They already run your servers. Adding AI to what you already use is less friction than learning a whole new system. Nightmare scenario for Oracle is that they become what's called infrastructure for infrastructure. They provide the database layer that sits beneath everything else, but they are invisible to the end customer. A bank uses Oracle to store data, and that data feeds into Microsoft's AI applications. Oracle makes money on the database, but Microsoft makes money on the AI, and the AI is where the growth and excitement are. That's not necessarily terminal for Oracle's business. Databases aren't going anywhere. But in the eyes of growth-obsessed investors, it means Oracle is the engine, invisible, dependable, slowly running in the background, while everyone else gets the spotlight and the stock price multiples that come with growth. Oracle isn't the only company getting hammered by the AI financing change, but the scale of the hit is telling. Intel has been circling the drain for years. They were the chip maker of the 1990s and 2000s, but NVIDIA ate their lunch when AI became the priority. Cisco makes networking equipment essential but invisible. IBM pivoted to cloud services but never caught up to AWS or Azure. All these companies share a problem: their infrastructure, and infrastructure gets less love than flashy AI products. But here's where Oracle's situation is different. Oracle owns the customer relationship. When a bank or hospital needs to store data, they come to Oracle. They're not comparing Oracle to some trendy startup that might disappear next quarter. They are locked in. Oracle has something precious, a moat that's hard to cross. The risk isn't that customers leave. It's that investors stop believing Oracle is a growth story. NVIDIA's stock can lose 5% and bounce back because the market trusts that NVIDIA is essential to AI. Oracle's stock is down 17% in a week because the market has doubts. Those doubts can linger for months or years, keeping the stock price depressed even if the actual business is doing fine. That gap between business health and stock price is where Oracle is trapped right now. And it suggests investors are asking a painful question. In an AI-first world, does database software matter as much as it used to? What happened to Oracle this week is a warning sign that the entire AI financing cycle might be getting unstable. Think about the structural problem. An enormous amount of capital is flowing into a few companies. NVIDIA, Microsoft, Google, Amazon, they're hoovering up funding and investor attention. Everyone else is competing for scraps. That's historically what happens before a market correction. Money gets concentrated, less glamorous sectors starve. And then something triggers panic. A company that seemed fine suddenly looks like a bad bet. Here's what makes this different. AI investments are real. NVIDIA makes chips that work. Microsoft and Google have real products, but valuations are based on predictions about the future, not current earnings. When investor confidence wavers, those valuations collapse faster than business reality would suggest. Oracle's crash is a crack in the foundation. It's revealing that investors have stopped asking, does this company work? And started asking, is this the company that wins the AI race? And when you change to that question, being a profitable database company isn't enough. You have to be the chosen one. The real implication: if Oracle, a company with 50 years of proven revenue, Fortune 500 lock-in, and billions in profit, can lose 17% in a week on slightly softer growth, then any company not demonstrably winning the AI race is vulnerable to similar collapse. That's a dangerous environment. So what should you actually watch in the coming weeks? There are 3 things that signal whether Oracle's crash is a one-week panic or a genuine repricing of the company's value. First, watch the earnings guidance for the next quarter. Oracle management will likely try to calm nerves and reaffirm their outlook. If they sound confident and customers are still signing contracts at normal rates, that suggests the crash was overblown investor sentiment. If guidance comes down, that's a signal the sales team is actually seeing softness. Second, pay attention to what happens to other database and infrastructure companies. If Intel, Cisco, VMware, and others hold steady or bounce back, that suggests Oracle took a hit specific to their situation. But if they all get dragged down over the next month, that's a sign investors are systematically selling infrastructure companies and reallocating to AI winners. Third, watch the cloud wars. Azure, AWS, and Google Cloud are all trying to build better AI tools within their existing services. If Oracle Cloud's growth accelerates in the next quarter, that suggests they are finally making headway in the market. If it stays flat or slows further, the crash will likely stick, and investors will keep worrying. The bigger lesson is this: the AI boom is reshaping which kinds of companies investors love. That reshaping isn't finished. There's going to be more collateral damage before it settles. Here's what this Oracle crash really means. For 50 years, the strategy for tech investors was simple: find companies with lock-in, predictable revenue and hold them forever. Oracle was the textbook example. The problem is that strategy is dying. The market is asking a new question now. Can you grow fast? Are you essential to AI? Oracle's answer right now isn't convincing enough. They've got $40 billion in revenue and they're making good profit. But they're growing slow and nobody's convinced their AI strategy is actually differentiated. That combination is lethal in this market environment. But here's what matters for you as a viewer. This isn't just about Oracle. This week was a signal that the entire technology landscape is being reshaped by AI financing. Companies that can connect to AI growth are getting loved. Companies that sit outside that narrative are getting sold. That's going to keep happening until the AI boom either delivers on its promises or we run out of money to fund it. The smart play right now is paying attention to which companies are actually winning the AI race versus which ones are just trying to add AI as an afterthought. Oracle's crash suggests the market is getting better at making that distinction. You should be too. Subscribe to the channel for daily updates on how this story unfolds. There's going to be plenty more surprises coming.